All right, so in this lesson, we're going to be looking at the four transactions that deal with the four accounts that deal with transactions that don't cover the full 12-month span, right? So if you remember properly, or if you can really think about it, the income statement, right, is our transactions for 12 months, right? So think about it like your own personal spending. If you took a phone on contract and then it was for 24 months, right? For 24 months, your income statement for the year 2025 is going to present all your payments that you did in the first 12 months, right? From January to, my December is a bit too close here. From January to December here, right? And then if you paid 100 Rand each month, 100 Rand towards your cell phone contract, that means at the end of the year, you should have paid 1,200 for that full year. But then, with these four transactions, we're looking at the case of what happens if perhaps from January to November, you're able to pay your account on time and everything as well. But then come this last month, from November to December, you are not able to pay that 100 Rand, right? In your income statement, we are supposed to account for the full 12 months. In your income statement, we account for the full 12 months because the rule is that we show every account, every expense, every income as the full period, whether we paid it, whether we received it or not, right? So your income statement is going to reflect 1,200, but then remember that you were not able to pay this 100 Rand. Therefore, this 100 Rand is going to be reflected in your balance sheet. And under your balance sheet, it's going to come out, or it's going to be one of these four transactions, these four accounts, right? So it's going to be 100 Rand there, right? But now when you're looking at this, you can say that, oh, I'm actually paying 1,300, some say like that, 1,300 in total. That is not the case. You're not paying 1,300. What you're doing here is essentially, in your income statement, you paid 1,100, and then the other 100 Rand went to your balance sheet. So your total actually becomes 1,200 Rand, as you're supposed to, right? This is what you paid during the year. This is what you will pay in the next financial year, in 2026. 2026, whatever problem you had in December. So let's say, for example, you run a tutoring company like me, and during November December period, students are done with exams, everyone is going back home, no one needs tutoring, no one wants to stress about accounting and maths in December. So when that period of time comes, I do not have that income for December, so I will not be able to pay that. But come the new year, come 2026, I am going to have to pay that extra 100 Rand in this period, in addition to the 100 Rand that I'm supposed to pay for January. Do you see that? So the income statement is going to reflect the full amount that you're supposed to pay. But because you know that only 1,100 Rand was paid, the rest of it goes to the balance sheet. I put too many zeros there, right? 100 Rand there. So The question now is, what is the difference, right? The ones on the left are liabilities. If you want to cram it for now or whatever the case may be, the ones on the left here are liabilities, right? And the ones on the right are your assets, right? So we're going to look at each one of these. Why is it a liability and why is it an asset? Looking at income received in advance. Income received in advance is a liability because let's look at in advance. Let's look at an income such as rent, right? You charge rent to the people who are renting out your place from the building that you have, right? You charge them a monthly rent. We're going to make this simple and say you charge them 100 rand every month, right? So remember, these four accounts arise from the problem that we don't meet in the income statement, right? There's always an issue in the income statement. Hence, these four accounts have to be consulted, if I can put it that way, right? So income received in advance, 100 rand rent every month. Now, looking at our income statement, we have our 12 months there, Jan to December. Every month, you're supposed to get 1,100 rand. So your total there should be 1,200. But now, the person renting from you in December gets a bonus and says that because I know that I am very irresponsible with my money in December, I'm going to spend it all, and January I won't be able to afford rent. So, in order for me to avoid that, let me also pay my rent for January. That is income received in advance, right? Like the name says, it is money that you're supposed to get, income, and you received it in advance before that time comes. Now the issue for us, the business, remember we're getting this money from our customer, from our client. The issue with us as the business is that we can't count this money as revenue or call it sales because this period has not taken place yet, right? So if we're in December and this person pays for January, January hasn't happened yet, meaning that any time before January month end comes along, this person can say that I want my 100 rand back, right? And because of that, we make it a liability, right? Now, once the new year begins and January is part of that year, then we can say that this 100 rand is now recognized as income and it's no longer liability. So the way this would look if you're doing your journals is that when you first receive the amount, say they paid rent. Rent is an income account, so it increases on the credit side, right? Rent, they pay 1,300, right? So remember, it's the 1.2 for the 12 months and 100 rand for that extra month. So it's 1,300, and then this is bank. We got the money from our bank account and this is debited 1,300, right? Now remember, this money we can't consider it as rent because our year consists of 12 months, but then here he's given us, or she has given us, an extra month, so we have to remove this extra month. What we do is we debit rent with 100 rand and we credit income received in advance. And we credit income received in advance, right, for 100 rand. Look at what that does to our rent income account, right? Rent is an income account, meaning that it increases on the credit side, decreases on the debit. First, we received 1,300. Then minus the 100 rand that went to income received in advance there. Then what happens now? We're left with 1,200 rand there, which is the correct amount on that account, right? Then when the new year comes along and then January falls due, meaning that this is now okay, this month is okay, we now say that rent for the new year, remember now the balance on rent is 0. All expense accounts and income accounts are closed off to your profit and loss at the end of the year. So rent now becomes 0. Then in that case, you're going to bring back this 100 rand from income received in advance. So you're going to say 100 rand here, income received in advance, and then you're going to say that 100 rand came in now. Remember here you took it out and you took it to income received in advance, and then when that time comes due, you no longer owe that customer, because now remember they did not pay for they paid in advance for January, and then now they lived in your apartment or your house in January, so they have to pay rent. And then now you don't ask for that money for them to pay you because they paid you in December. You just fetch it from your account that you hid it in income received in advance. So in a way, you can think of these accounts as your saving account. Like, I have this money, but I'm not gonna use this money as if it's mine, right? Another quick, very lazy example that I can give you is that if me and you are friends, wouldn't that be such a nice thing? Me and you are friends, and then you give me 100 rand. You say to me, look, I am going to the mall. Can you hold this 100 rand for me? Right? Or, no, that's a bad example. You're giving me 100 rand and you're saying to me, can you give me a tutoring lesson? But not now. Just hold it for me, and then after 2 days, I'm going to come back and then you can tutor me. Because I have this money now, I'm afraid if I leave with it, I'm going to spend it. And I say, fine, thank you. But this 100 rand, I can't spend it. I can't just go out and buy airtime and whatever the case may be. Because if you come back within those 2 days and you say to me, there's been an emergency, you are in the right to say, give me back that 100 rand. I want it. It's mine, right? We are forgetting the fact that some people steal in the world. Don't know who I might be talking about, but we're forgetting all that. In a very perfect sunshine and rainbows world, you want your 100 rand back, right? So you gave it to me, and then to me it became a liability, right? And then now you're asking for it back. You should be able to get it back, right? But if you don't ask for it back, and then 2 days later you come back and then I tutor you, then this 100 rand is officially mine. I can go buy sweets, I can go eat McDonald's or whatever the case may be. It's now mine. So income received in advance, you are the business and you're paid in advance, but you cannot look at that money as revenue. You cannot spend it up until you have fulfilled your liability to the person who gave you the money, whether it's giving them stock or them paying rent. Accrued expense is similarly 12 months there, and then this is in the eyes of the business, so January to December. Accrued expense is us saying that we have to pay our telephone bill, which is 10 rand per month. So the total that we're supposed to pay is 120 rand. but we're only able to pay it up until November, right? Do you see that we are the ones who's supposed to pay? In income received in advance, we received money, but in accrued expense, we're supposed to pay, right? But we're only able to pay for this 11 months, which is only 110 rand, right? And then the thing that's missing is this 1 month of 10 rand. So accrued expense, in our accounting books, we're going to say then that, looking at that, we're going to say bank we're paying, so bank is an asset. We're going to say bank there, it gets credited with 110 rand, right? Remember what we paid. We only paid 110 rand. Then what was the expense? Telephone gets debited. Telephone with 110 rand, right? But now remember we said whatever the case may be, your income statement must reflect 12 months. Saying that my telephone bill was 110 rand is not fair, because my telephone should reflect the full 12 months, and the full 12 months is the 120 rand. So what I'm going to do to add that extra month, I'm going to say this is debit, this is credit. That's the first account. Second transaction is I'm going to debit telephone, right? To say that the full amount I was supposed to pay was 120 rand. No, sorry, not 120 rand. I'm supposed to add another 10 rand to the account. But where does it come from? I'm going to credit this liability that I'm creating, accrued expense. I'm going to credit it with the 10 rand. And then look what happens now. If I create the telephone account, telephone is an expense, so it increases on the debit side, decreases on the credit. Remember, the first one that got debited was bank. Have it here, bank. Then the second one was accrued expense. So what would happen here is I'm going to say plus bank 110. Then I'm going to say accrued expense AE plus 10. Now I'm going to erase this to make it look a bit neater. If you add those two up, it's going to say 120 rand, which is the amount that I'm supposed to actually pay for the year. Do you see that? Then in the following year, because this is a liability, and remember it's a short-term liability. These two liabilities are short-term liabilities. So a short-term liability is a liability that come end of the year you create that liability, but come the following year you're gonna pay it off. It's a liability that does not last longer than 12 months. So these two are short-term liabilities, right? And then here we just created one with telephone and that expense there, right? So those are our two liabilities. And then if you can see here, you're going to see in a minute that income received in advance is just the opposite of prepaid expenses. And accrued expenses is just the opposite of accrued income, right? Let's make an example with prepaid expenses, right? Remember, income received in advance, we had someone renting from us and they paid in advance. They paid 1 month in advance. The same way with prepaid expenses. Prepaid expenses, we have our 12 months there, right? 12 months, Jan to December. We have our 12 months there. And then we decided to pay, let's say, water and electricity. I'm going to put it in brackets. Water and electricity there. we decided, and yes, that is an E, right? We decided to pay an extra month, the month of January. We decided to pay if this thing is 20 Rand per month times 12 is 240 Rand. So we were supposed to pay 240 Rand. That is the original amount that we were supposed to pay, 240. But we paid an extra 20 Rand here, making our total now 260, right? Same principle as income received in advance. Income received in advance, they paid ahead of time, and then we had to deduct it, and then when it comes due, we then say that they paid it. But up until that moment, we owe them. In this case, when we are paying ahead of time and it's prepaid expenses, they owe us. So if I'm creating a T account here for water and electricity, remember that is a expense account, meaning that it increases on the debit, decreases on the credit. Your bank here is going to say bank for how much? 260 Rand, because that's how much we paid in total. We paid for 13 months and not 12. But the income statement, the rule on the income statement is always 12 months, right? Do you see here that they paid for 13 months here? They paid for 13 months, and then we deducted 1 month here. We deducted 1 month here, right? In this case, we paid for accrued expenses. We paid for 11 months here. We paid for 11 months and 1 month behind, and then we had to add the 1 month, right? So you see the pattern whereby your income statement must always reflect the 12 months in the year. Whether you paid it or whether you didn't pay it, it must always reflect that period. So in this case, we're going to say this reflects 13 months, this amount of 260 Rand. So how do we take it out and make it 12 months? We're going to deduct it by saying prepaid expenses. Prepaid expenses minus 20 Rand. So you're going to say 260 minus 20. That's going to give you a new total of 240. Now, why do we say this is an asset? The same way in income received in advance, when we paid ahead of time, when they paid ahead of time, they could come anytime and say, give me back my money because I haven't used the service. The same way, if we are saying we have water and electricity and then we pay ahead of time, end of the December, if we're short on money, we can say, no, give me back this 20 Rand. I need it back. I need to pay employees or whatever the case may be, right? And that is why it's an asset. Assets, remember, it's money that is owed to you, or stock, or land and buildings, or whatever fixed assets, or actual cash, right? So this that is happening here is the same as saying that water and electricity are now our debtor. The same way debtors owe us money, water and electricity owes us money. And in the same way, when a debtor pays us, they no longer become a debtor. When we use that water and electricity, the water and electricity account, the municipality, are no longer our debtor, right? So for the last one, accrued income. Remember accrued expenses, we paid for 11 months. We paid for 11 months and it was supposed to be 12 months. Accrued income is income that we were supposed to receive for 12 months, but we only received for 11 months. So in this example, let's say rent once again, we only received up until November there. So what we're going to do is say rent income, rent income there. There's the account, and then if they were supposed to pay 100 rand times 12 months, it was supposed to be 1,200, but we only received wrong side. That's why it's important to classify income, debit, decrease, credit, increase, and then it says bank. It was supposed to be 1,200, but they gave us without 1 month's rent, which is 100 rand. So they actually just gave us 1,100, right? So we're going to say bank 1,100, but then remember, income statement is supposed to reflect 12 months. So whether we received the money or we didn't receive the money, it must reflect 12 months. So there, it must say 1,200. We left with 100 rand there, and then we're just going to call this accrued income. Right? Oh, come on, eh? Alright. And then this account is going to be closed at the end of the year. The beginning of the new year, we're going to say, sorry. Oh, yes, accrued income. Right? And then you see now this account is now full. It's 1,200. It's the whole thing. When they actually pay that money, for whatever case it may be, it's going to come to bank because they're actually paying it now. And then plus minus, and then 100 rand, accrued income, 100 rand. Right? So this was more of a overview on these 4 accounts so that you are able to understand them and how they work and why they're there. I put them this way so that you're able to understand them, right? These two are liabilities, right? I just made that part disappear. It was not on coincidence. These two are liabilities and these two are assets, right? But then if you just remember that these two here, income received in advance and prepaid expenses, are the same thing. Income received in advance, they are paying us ahead of time. Prepaid expenses, we are paying them ahead of time. Accrued expenses and accrued income are the same thing. Accrued expenses, we have paid for less than 12 months. So whatever the expenses, we paid for less than 12 months. And then accrued income is them paying less than 12 months. They are paying us for less than 12 months. If you're able to grasp this little introduction to these terms, and even if you knew them but just this refresher, then you'd be able to attend to the exercise that I'm going to record and post here, and then you'd be able to follow with me as I do it, right? So this is literally all that you do here. Grade 10, I think grade 10, yes, grade 10 and grade 11, this is pretty much the accounts that you're going to record when they give you this. And then when you get to matric, you should be able to do this and know that when I do a transaction like this and it's telephone and it's accrued expense, this 10 rand is going to go to the balance sheet under current liabilities, and I'm going to add 10 rand to either accrued expenses or trade and other payables, right? But going from here, not understanding this and knowing how to do this automatically is like taking your first day on a bike. You've never ridden a bike, you've never done anything, and you just take that bike and you go to a skate park and you want to do tricks. It's impossible. It's not going to happen. Just understand your fundamentals. First, understand this theory part, understand this video, grasp the ideas of this video. Then we're going to do the transactions, the basic transactions together. And then once you hold those two as a foundation, you're able to build up and do this without the transactions. All right.